What is the lot size? In the past, spot forex market only traded in the specific amounts called lots, or basically the number of currency units you will buy or sell. The standard size for a lot size is 100,000 units of a currency, and now there are also mini, micro, and nano lot sizes that are 10,000, 1,000, and 100 units. So lot and number of units. Then we've got standard lot. We've got 100,000 units. That's where when you say 1 lot, one standard is close to 100,000 units of currency. Mini lot, we are referring to those with 0.1, 10,000 units. Micro, we are talking of 1,000. That is 0.001. It is equals to 1,000 units. Nano, 0.0001, but not all brokers offer this one now. Some brokers show quality in lots, while other brokers show the actual currency. Just a minute, someone is saying the link is saying invalid. So I'm just sharing the link with them in the group. Okay, some brokers show quality in lots, while other brokers show the actual currency units. As you pay, you may already know the change in the currency value to another is measured in pips, which is a very small percentage of unit of currency values. To take advantage to this change in value, you need to trade large amounts of particular currency in order to see any significant profit or loss. It's not about trading huge quantity of lots. This thing of forex is not based on how much do you have. That's why there is what they call leverage. If you with leverage, even if you with a small lot or with a small account size, you can be able to trade. So that's why they've introduced something called leverage. Okay, let's assume we will be using 100,000 units standard lot size. We will now recalculate some example to see how it affects the pip value. Okay, let's give only USD JPY as an example. Exchange rate of 119.80 is equals to 0.1/. It's like your mini lot 0.01. Your micro lot times 100,000 of units. So per every 1 pip, you get $8.34 per pip. So what you should know is this as well. When you are trading currencies, some of the pairs they pay more money than others. Why? It's because of the pip value that has been pegged to each currency. As you can see on USD JPY, same example gives you $8.34 per pip on USD JPY, and on USD CHF it gives you $6.87. This is a good example. Another example on Euro USD at an exchange rate of $0.19. If you calculate times 100,000 units, you get $9.99 or rounded to $10 per pip if you're using one standard. Then GBP USD, you get also the same value, pip value. Here are examples of pip value for Euro USD, JPY, depending on the lot size. As you can see, there is an example. Euro USD close price, any price, units 0.001, and you are using this one. 0.001 is goes to 100,000 units. Standard lot times 10. So it means pay one lot. If you are trading in USD, you get $10. Mini lot, you get $1. Micro lot, you get 10 cents. Nano lot, you get 1 cent per pip. Okay. Let me try to explain what is a leverage. What the heck is a leverage? You are probably wondering how a small investor like yourself can trade such large amounts of money. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All the bank asks from you is that you give it 1,000 US. So if you want to, it's like if you want to borrow money from the bank, they can give you $100,000 to buy currencies. But before they give you 100,000, they need you to give them 1,000 as a good faith deposit, which will hold for you, but not necessarily keep it. It's like if you want to borrow money from them, they can give you 100,000, but they want you to deposit 1,000 US dollars. So the amount of leverage you use will depend on the broker and what you feel comfortable with. So when choosing leverage, there's one thing that you guys should know. What you should know is this: the bigger the size of the leverage you're choosing, the higher your risk is. So let's say we have two people. The other one they've got the account of $100 and the leverage of 1,000 is to 1 is to 1,000, and the other one has got $100 and a leverage of 1 is to 1,000, 1 is to 400. So what will happen is this: the one with bigger leverage can open more positions. Let's say you open the trade, you can open more positions with $100 with big lot sizes as well. But the one with small leverage cannot open bigger lots, one. Number two, cannot also open multiple positions. Why? Because of risk. So the one with more positions, it is easy for them, or the brokers, it is easy for them to blow your account. Because why? If you have $100 and you have opened many positions, it means you didn't follow risk management, one. Number two, your risk is bigger than the one with small leverage. So that's why some of them, they offer leverage up to 3,000. It's a way so that you think you will make more money because you have bigger leverage. But to them, they know if you are choosing bigger leverage, they will class you into a certain server. Normally what they do is this: when you open an account, normally the brokers will ask you some questions. So you are grouped according to the questions that you have asked. And you also are grouped according to the leverage that you have chosen. So the bigger the leverage, the higher the risk. So what they do is they know people with small capital, they normally choose high leverage. So if you want to compare or see how these guys can take your money, let's say you are using XM broker, your server is global rewards, maybe server 20 something, and you go and compare your price on your MT4 with another one with a different server. Let's say maybe the server is 90. You will see your price on the charts, or the sizes of the candles, even the shapes of the candles will be different. So that's why they group you according to what they want. So leverage is just used for you to think you will make more money, but them are the one who's making more money. Okay, the document I'll just share in the group today. This one I'll share once we finish all the lesson because it's a bigger document. I'll just share it. I'll just share the whole document with you guys. Okay, I think you also know what is called bid or ask. Remember, when you enter or exit trade, you are subjected to spread in the bid or ask court. It's like whatever business that you need to do, you need capital to start a business. So let's say you opened your account. The brokers, they make money from different things. One, they make money from spread. That is difference between bid and ask. So they make money. If you open trade, they make money. Nowadays, some of the brokers agreed. They take spread and they take commission plus swap. So even if we have got, let's say, 10,000 retail traders on a broker, and all of you are making money, the broker will still make money. Why? Because they are taking spread, they are taking commissions, they are taking swaps from you. So for them, it's enough. So when you make losses or blow your account, it's just a bonus to them. Okay, let me now go to, yeah, I spoke about order types. A market order is an order to buy or sell at the best available price. This is when you, let's say you want to trade and you are not going to use pending orders. Where let's say the price of euro dollar is $1.17. The moment you click buy, the broker is going to offer you at that price. This is what is called, it's like instant execution. For example, the bid price for euro dollar is currently at $21.40 and the ask price is set at $21.42. If you wanted to buy euro USD at market, then it would be sold to you at $21.42. You click buy and your trading platform would instantly execute a buy order at that exact price. Okay, don't worry, guys. On these basics, we are also going to teach you about the platform. Some of you may not know how to use it. So later on, not today, not tomorrow, but eventually we'll get there. We'll teach you what you do, even how to open an account. So don't worry. I'm seeing some questions. Someone is asking. So, okay. Limit order entry. Limit entry is an order placed to either buy below the market or sell above the market at a certain price. Buy limit, order placed below the price and price goes up. Sell limit, order placed above price and price then go down. Okay, what will happen? Let me try to explain in this way. Those in Zoom will get this easy. It's like if you go into the streets in Zimbabwe, there are some guys who do exchange rates there. If you want to go there, you want to buy dollar, they will say we are selling dollar at let's say 130 RTGS. But if you go there with your dollar, they will say no, we are going to buy your dollar at 90. So the gap between 90 and 130, that's what is known as spread. So you will be paying spread every time you go and change your money in the streets. So now what happens is this. With buy limit order now, let's say you went to the streets and they told you our dollar is at 30, and you say, today I'm not going to buy dollar at 30. I'll wait for this price to drop to a certain level. Then I'll come back and into the streets again. When the dollar maybe is down with 20 or so, it's about $10. Then you say, now I can buy the dollar. So this is a physical thing that you do. But on platform, MT4 platform now, what you do is you can set this thing manually. Let's say your price is at, okay, let me try to draw if I can here. They won't allow me to draw. Okay, let's say your price is at, or if Euro USD is $22. You put your order on your platform and you set a pending order at $15. Why? Because you want the price to come to $15 first. Then the moment it triggers your order, then your order will be executed and you now buy that dollar. So what happens, this is automatically now on the MT4. You wait for them or for the market to move to your price. Then if your order is triggered and the market goes back to $22, you have made a profit. But if it keeps on going in the opposite direction, it means you are in loss. So sell limit, order placed above the price, and the price goes up to trigger order, then it goes down. Let me try stop entry. On stop entry now, stop entry is an order placed to buy above the market or sell. It's like now when you want to enter a trade, the euro is $10, and you are thinking the euro will keep on going $20, $50, or whatever. So what you do is you place your order above the price. If the price is at $10, you place an order at $12 in the anticipation of saying the dollar will keep going up. The euro, sorry. So that's the same, the opposite with sell stop. Order placed below the price. When you're anticipating the price will keep going down. Then a stop loss order. Stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. Stop loss order for us, we say we use it to filter bad trades, but it also works together with risk management. For me, when I trade, I always say I don't risk more than 3% of my account. So it means size of my stop loss should be 3% of my account, not the size of the lot size, but size of the stop loss. Where I'm going to put my stop loss, if the market maker hit my stop loss and they refuse to go, they will take out my 3% of the account only. So on stop losses, we've got two types. We've got what we call jump stop, where you move your stop loss manually. If you are in profit, you move your stop loss manually. And we've got also what we call trailing stop loss, where the market will be moving your stop loss automatically to a certain number of pips that you have set. Let me try. Trailing stop loss is a type of stop loss order attached to a trade that moves as the price fluctuates. Let's say you have decided to short Euro USD JPY at 90.80 with trailing stop of 20 pips. This means that originally your stop loss is at 91. If price goes down, hits 960, that is 980 minus 960, your trailing stop loss would move down to 1980 to break even. So it means if they come back, they'll close your order with zero profit or zero loss. Just remember though that stop will stay at this new price level. It will not widen if the market goes higher against you. Going back to the same example, with the trailing stop of 20 pips, if USD JPY hits 940, then your stop loss would move to 90.60 or lock in 20 pips in profit. Your trade will remain open as long as the price does not move against you by 20 pips. Once the market hits your trailing stop price, a market order to close your position at the best available price will be set and your position will be closed. So this is basically about lot sizes, and also about I also spoke about leverage. So I hope you now know what is leverage, what is buy stop, order placed above the price when you're anticipating the price will keep going up. Buy limit, order placed below the price when you anticipate that the price will go down first before it continue going up. Sell stop, order placed below the price. You place a trade below your current price in anticipation that the trade is going to continue. Then sell limit, order placed above price, then goes down. You're anticipating that this price is going down, but before it goes down, it has to go higher to a certain level, then it will keep going down. Let me see what else can I do. What else? For today, let's just stop here. For tomorrow, guys, I'm going to talk about Forex broker types. I will explain what is a broker, how do you choose a broker, and also explain what should you look for when you are choosing a broker. Then I will explain the types of brokers that we have, because we've got plenty types of brokers. And I'll also explain what you should avoid when you are choosing a broker. So for today, thank you guys for joining this meeting. So let me just stop it here. So tomorrow I'll start with Forex broker types, dealing desk, what I will teach you and try to explain as best as I can. Thank you for joining, guys. Tomorrow I hope you share with your friends and family so that they can get advantage of this. Okay, thank you. See you tomorrow, guys. I'm going to stop here. So those who need further explanation, I'm going to upload this on our YouTube channel. Just go and revise. If you have questions, you can ask there on the YouTube channel. You just ask your question. I will do live when answering those questions. So thank you very much for today. See you tomorrow, same time. Tomorrow, I think I'll start at 9. I'll try to explain as best as I can. Thank you.